Let's welcome in our next guest. Mihir Vora is now joining us. Mihir, thank you so much for taking out time for us. Goldman has released a big India strategy note today. I know you cannot comment on others' notes, but 10,800 is their target for Nifty in the next 2 years. Do you think it's an achievable target?
Yes, we do expect about somewhere between 9 to 13-14% returns in the next 2 years on an annual basis, as far as the markets are concerned. So to that extent, yes, if it's a 2-year target, it is in line with those estimates, because earnings growth for the markets are expected to be close to 13 to 16% in that range for the next couple of years. And we don't expect the markets to get re-rated too much from this point in time. So it's pretty much going to be more earnings driven.
Right. Let's just then talk about earnings. So last, 3 years, 4 years, whenever you have come on our channel, we've always spoken about earnings and how earnings have constantly been downgraded. Do you think any hint in Q4 or Q1 where essentially, there would be an earnings recovery, you think the markets can go up further? Any hint of earnings recovery, a possibility of a double-digit growth in Nifty earnings, you think markets can further go up?
Yes, if Q4, especially at least if you look at the leading numbers, it doesn't look like a blowout quarter for sure. So we are basically banking on Q1 of next financial year, that's the June quarter and the September quarter. And that's when we'll basically get to set the pace for the rest of the year, because I think we've seen a lot of negatives in this financial year. So hopefully the worst is behind us as far as the disruptions or etc. are concerned. So next couple of quarters will be interesting to watch, whether the whole theme of a broad-based recovery based on consumption and government spending, and hopefully private sector investments coming towards the end of the financial year can lead to this 7.2 to 7.5 kind of a GDP growth and about 13 to 15% earnings growth. So it's going to be, yes, given the fact that markets have run up, it's going to be interesting times for the next 3 months.
Right. In terms of earnings, a lot of people are saying that last 5 years earnings growth has not been that great on an aggregate level. And that's why it's the base effect because of which you will grow 15 to 18%. But it really doesn't matter. 15 to 18% growth will attract investments.
Yeah, I mean, you're right. In the last 3 to 4 years, earnings haven't gone anywhere, but so haven't the markets. So pretty much the markets have tracked earnings growth if you look at the big picture. And if earnings kick in, the markets have to do well. I agree with that.
Right. In terms of flows, FIIs are probably the one that have not invested so far in the market, or in the recent rallies, DIIs have invested earlier, FIIs are coming in later. If there is a hint of earning recovery, you think FIIs will start to pump in money again via ETF, irrespective of the levels?
I don't think FIIs have been waiting for any kind of recovery or some kind of a trigger for India, because I think by default India continues to be a relatively attractive destination. I mean, we may try to be finicky and say we want 7.5 and 7.2 GDP growth rate is not good enough. But from the FII point of view, even a 7% growth is much higher than the rest of the world. Even as far as the fixed income markets are concerned, Indian yields at close to 7%, and the fact that currency is reasonably stable offers a good carry trade even in the fixed income space. So I think FIIs will continue to be bullish on India. They have been bullish on India. The month-on-month or quarter-on-quarter fluctuations that you see in the FII flows are more linked by their own asset allocation decisions rather than their change in views in India. I think India by default continues to be a overweight for FIIs, and that I see continuing for a while.
Right. What's happening with DII flows? Do you think DII flows continue to be strong? It's still quite strong, even if it's still quite minuscule in terms of a portion of the shareholding pattern, if you would, include the last 2 years of inflow?
Yes, not only in terms of the shareholding pattern, where of course we have seen healthy increase in the institutional ownership, and that indirectly means retail ownership, because it's ultimately retail investors who are putting in money into mutual funds and insurance companies. But if you look at the overall pattern of financial savings versus physical savings, which really got distorted in the time period from 2010 to 2015, is getting normalized. So I think we are a far cry even from normalizing the distortions corrections that we saw between 2010 and 2015, and that itself should see local flows continuing into the equity and fixed income markets.
Right. Can you just tell us what your experience has been? So FII flows, of course, are also known as hot money. It tends to go when there is some problem. It tends to come in when things are looking good. But with DII money, you think it's more sticky in nature, so it stays for long term?
Well, I think even FII money is reasonably stable because, again, if you step back a little and look at the 15-year history or probably 20-year history since the time FIIs came in, there have been only 3 years in which we have seen FII negatives. So they have been pretty consistent investors in the country. So I don't think we should treat them as hot money. Some of the hot money does come in into the fixed income market depending on the spreads and carry trades. But equity money generally has been quite long-term in nature from as far as FIIs are concerned. On the local money, I think there are a couple of components that are very interesting. One is, of course, the broad space of insurance and mutual fund inflows. That has tended to be a relatively stable space. What we have seen emerging in the last 3 years is the size of the discretionary portfolio management services, the PMSs as we call them, and those have grown to a critical size. If you look at the data, I think that itself has probably gone up to maybe 70,000 crores to 90,000 crores in equity AUM in the last three years or so. Now we haven't tested how stable that money is, and that we can only understand once, if at all, we see a sharp correction, and then investor behavior will kind of pan out. But as far as the mutual fund and insurance money is concerned, I think it's reasonably stable.
Right. In terms of earnings and earnings impact, so demonetization is behind, PSU recap or PSU write-offs is behind, and metal prices are probably off their worst. Do you think GST can be a disruptor in earnings? How would you look at it? It's such a big tax change that it can be disruptive, but benefits will follow in 19?
So in terms of the PSU write-offs, I kind of differ a little. I don't think the worst is behind us. There's lots more restructuring and provisionings to be done. If you look at the overall portfolios of the system, I think there is enough stress in the system. So the PSU banking space is still not out of the woods. A lot of restructuring and a lot of capital will have to be put in one way or the other. As far as the demon impact is concerned, we have seen that while there has been a decent recovery in the share prices, the underlying top line growth is still not that great, in the sense we have seen disruptions in certain segments. So it's not like it's been a V-shaped recovery. It's been a decent recovery, but I would say share prices have more than factored that recovery in. GST will be an interesting one. It looks like we are targeting the July 1st deadline, and to that extent, while on paper it looks like there could be some disruption as companies and all figure out their MISs, the reporting systems, even the modalities are going to be worked out, and we don't have all the details as far as the operational aspects of GST rollout is concerned. But going by the demon experience, probably it may not be a wise thing to be very concerned about this, because we have seen the Indian entrepreneur being quite innovative and flexible and creative, so to say. So I think we'll get over it even if there's a disruption.
Right, but as an investor, especially as a long-term investor, what your company is, how would you look at the impact? Do you think that it will be very short-lived in terms of impact, and you would look at the long-term benefits and start to invest as details of GST come out?
No, absolutely. I mean, there's not much to be studied. The fact that there is huge long-term benefits is a given. There will be a structural change in our fiscal deficit, in the shift from unorganized sector to organized sector. We will see the larger companies and the employment that they generate with the proper payments of provident fund, social security, medical, etc. That will have a long-term trickle-down impact on the manufacturing side as well as on the the employment generation side. I think there is no two questions about it. We are in for very good times as far as tax collections are concerned and budget deficit is concerned. So structurally we are in for lower inflation, lower interest rates, lower fiscal deficit and a stable currency. I think those long-term benefits are far going to outweigh the short-term disruption, if any, that we see.
Right. In terms of, what's remaining, so, PSU banks, the point that you made right now that, a lot of, worst may not be behind. You think any material solution or any solution which could, take the problems of PSU banks away or takes the problem of, these bad assets away, you think overall market would do well? Overall market can re-rate because of that?
So one way or the other way you look at it, it has to be capitalized. The banking system needs capital, whether it's in the form of shifting assets to a bad bank or directly capitalizing the PSU banks themselves. But the fact is that the size of the problem is quite enormous, and it's not within the government's resources alone to solve this issue. So while it will require a lot of direct resources from the government, it will also require a lot of creative thinking and participation by the private sector. There has been some buzz in the last few days around some kind of a incremental package coming in, or some kind of a intermediate structure coming in, but we'll have to see it as it comes.
Right, but do you think that is something which the markets are waiting for? It's probably the only thing remaining, which markets expected to happen but has not happened as of now?
I don't think it will be a big bang thing, frankly speaking, because it cannot be a big bang just for the fact that it requires enormous resources, and I don't think the government is in a mood to promise upfront a huge amount of resources. Probably it'll be a structure for dispute resolution. It will be a for what you can say speedy dispute resolution, etc. But the fact that even if there's a dispute resolution, write-offs will have to be taken, NPAs will have to be recognized, and that will require capital or write-downs in one form or the other. So I don't think it's going to be anything big bang, frankly.
Right. Let's talk about the private sector banking space then. They have continuously been compounding stories. You have told us earlier that, you would be perpetually bullish on these names till the time they are showing growth. Now, a bank like Kotak Bank, they came out with the 811 app day before yesterday, which is giving all the services for free if it's digital. Do you think it's a start of disruption in the private sector banking space where people are struggling for growth and they are coming out and giving things for free if it's done digitally?
See, broadly speaking, technological advancement has to happen, will happen, and the faster the banking system accepts it, the better. There will be winners and there will be losers. So people who adapt faster probably will be the winners, and people who follow probably will be the losers. So to that extent, I think there's a definite march towards automation. There's a definite march towards mobility, banking services through mobile, etc. So the fact that some banks are adapting it faster, some banks are probably a bit slower, doesn't change the fact that we are going broadly in that direction. And the core strength of the banking system, which is essentially collecting deposits, providing services to the customer, and lending to corporates and lending to the retail client, basically does involve ultimately underwriting skills, distribution skills, sourcing skills. So I don't think there is a scenario in which we are saying that internet banks or e-banks alone will take the space of the brick and mortar banks. I think ultimately the most successful banks will be the banks which will kind of evolve in a way that they offer all the range of services through all channels, whether it's a physical branch channel or a e-channel, depending on the needs of the customer, and let the customer decide. So I think the markets are going to be segmented in different ways. And I think the banks who provide a wider basket of services and platforms for customers will emerge the winners ultimately.
Also, if we just look at, what's happening in the private sector banks, so some of the banks are offering 6%, 7% interest rates on savings bank versus 4%. But that itself has not helped the customers to move. So it's very sticky in nature when you talk about private banks and the way people have operated accounts over there.
So we have seen that some of the successful private banks who have been offering a higher rate of savings account rates have managed to improve their CASA ratios quite significantly. So I would say that offering a higher interest rate alone is not enough. You have to back it up with the right branding, the right increase in branch network, the right distribution, and the right approach. But the fact that banks who have executed well have actually managed to increase their CASAs quite significantly.
Right. In terms of NBFCs, do you think that's a comfortable area? Do you think private sector NBFCs, which are very well capitalized, which have a decent brand name now, they would continue to grow?
Yes, I think we've discussed that in the past. Essentially, the fact that we just discussed about PSU banks having no capital to grow, frankly, and it will take a while to resolve the NPA issues, which means that there will be start-off capital for quite some time. Basically means that credit growth has to come from the private sector now, whether it's through private sector, new generation private sector banks, or the older corporate sector, private sector corporate oriented banks, or the NBFCs, which again are classified into housing, non-housing, more retail oriented, and then of course at the lower end we have the microfinance companies. But the point is that when an economy has to grow at 7.5%, credit has to grow at 10 to 12% for sure. And if that credit doesn't come from the PSU banks, it will come from the private sector. So the fact that 60-70% of the system cannot grow beyond say 5-6% means that rest of the 30% of the system will have to grow at much higher rates. So that structural change, I think, is there for the foreseeable future.
Right. Apart from the banking space or microfinance space, what are the other sectors that you like? Consumer durable, they have also been perpetual growth stories. Would you be overweight on these sectors?
Yes, that's where we see visibility of growth. The Indian consumer, frankly, has been the only leg, apart from government spending, that has kept the economy going for the last couple of years. We were expecting government and private sector capital expenditure to pick up much more, but that has frankly disappointed. So as we speak, we're still dependent on government spending and the private sector, rather the private consumption, to kind of prop up the economy. If the private sector investment cycle kicks off, that will be an added bonus, but that doesn't seem to be the case because we still have a lot of spare capacity in the power sector and other sectors.
Right. In terms of consumer durables, the point that you made about GST, how things would shift from unorganized to organized, it's very difficult to evaluate who will benefit how much or which sector would do essentially well within sectors, which brands would do well. But it's a very big opportunity, and that has been the play on some of these consumer durable over a period of years. They have gained from the unorganized market.
That's right, because not only obviously there is going to be a tax relative tax benefit for the unorganized sector, which is going to reduce, but also the fact that as the economy evolves and the consumer also evolves, there is always going to be this pressure for better quality products, and that typically tends to come from more the unorganized sector, branded quality products, which comes from the organized sector. So that again is a trend which probably may not be linked to taxes, etc., but it's basically based on behavior patterns, evolution of the economy. As the per capita income goes up, people do evolve to higher quality products, etc. So that's again a trend which doesn't need government interference. I think consumer preferences itself will shift businesses to the private sector. I mean, if you look at some of the large listed jewelry companies, for example, 80% of the jewelry industry even now probably is unbranded, but the branded players, though they pay taxes, are managing to grow consistently for quite some time. So I think that trend we will see across segments, not only in jewelry, but across all the segments where consumer will need better quality, better branding, and better service, of course, which basically means that the organized sector tends to benefit.
Right. Mr. Vora, for the fourth quarter, where do you see maximum outperformance in terms of earnings?
For the first quarter?
For the fourth quarter.
For the fourth quarter, I think the private sector financials have continued to show good credit growth, good growth overall if you see month on month. So that's where I think some excitement will be there. We also have seen quite consistent growth in some of the auto segments, sub-segments of the auto, and even some of the bounce back from the suppressed demand of the third quarter that we saw in the consumer discretionary space can continue to surprise on the upside as far as production numbers are concerned. So these are segments where we do feel that there could be some surprises on the upside.
Right. And where are you foreseeing weakness when it comes to earnings growth in the fourth quarter?
Weakness, I think some of the pharma companies still have not managed to come up or solve the FDI issues, they might continue to see slowdown. We also see IT as being kind of a so-so quarter, nothing dramatically different from what we saw last time. And some of the metals which did very well in the previous quarter may see some consolidation. So you may not see the kind of huge YOY increases that we have seen for the last couple of quarters. We might see some flattening of profit growth out there.
Right. If you think that the GST disruption may not be too long drawn or too huge, do you think we will really see any correction for the markets for those who have missed the bus or looking by? Because since December the corrections have been shallow, consolidation in the markets just move up. What would you advise investors who have not had the chance to participate in this rally over the last 3 months?
So it doesn't make sense to capitulate. The point is that it's always a better idea to plan out your investments in a staggered fashion so that you get a reasonably systematic investment, so to say. So essentially SIPs is typically the best way to go about investing rather than trying to time the market to perfection, frankly speaking.
Right. Do you see any concerns from global markets, any headwinds that could impact our markets? Over the last few days, we have seen the dollar consolidate. Our currency has gained quite a bit. But there are some worries about the French election, about what will happen with the new US Donald Trump regime. Could those factors impact our markets, or do you think we are going to be resilient and we will not see a very big correction?
No, those factors will continue to be at the back of our mind when we are looking at the markets for the next 3 to 6 months. All of those you mentioned, the French election, the US policy, not being very clear on various aspects, etc. And of course, we also have the Brexit now being triggered yesterday. So to the extent how it pan out, whether it disrupts trade flows, etc. in Europe. So those concerns are always going to be there. Plus, the bigger trend is that we are no longer in a more easy money scenario. I think the Fed and the ECB have clearly indicated that the best of the liquidity loosening is done, and now it will be more of a neutral stance, and the Fed has already started hiking rates. So to that extent, the best of the easy money probably is past us. And when markets are stretched at these valuations, and this is an issue not only for India, but even if you look at the global markets, valuations are at the higher end of the band. So valuations themselves leave very little room for any kind of disappointment in terms of growth. And if that disappointment comes from time to time, we will see some sharp volatility in the market. So I don't rule out volatility in the market in the next 3 to 6 months.
Right. Now, we have seen our currency, the rupee, trading at multi-month highs. It's below 65 to a dollar. Today, it's 64.8 to a dollar, levels we have not seen since maybe end of 2015. How do you think some of the key sectors are going to be impacted, be it oil marketing companies, be it auto ancillaries, or those companies that have a large overseas operations? What would you watch out for when those earnings come out for the fourth quarter?
This currency issue always comes up whenever there is a sharp move either ways. People tend to kind of trade around that. But I have, in my experience, except for probably a few weeks of plus or minus, I haven't seen the currency being a major factor as far as company results and company growth are concerned in the longer term. Whether it's IT, pharma, auto anks, or any other exporter. Ultimately, the fact is that these are segments in which we have already achieved global capacities and global economies of scale. So, 2 or 3% movement in the currency from time to time does not matter too much. As long as we have a broadly stable currency or a slightly weakening bias over the longer term, I think these companies are likely to continue to do well, frankly speaking. So, many times we have tried to trade around, especially in the IT segment, I have seen people trade around currency movement, but that really hasn't worked out in the longer term, because companies do adjust their cost structures, companies do adjust their salaries, etc. In case the currency appreciates. So I think what matters ultimately is the global size and scale that we already achieved, and that's going to excuse me, that's going to continue to drive growth for these companies rather than short-term currency movements, frankly.
Right. In terms of, the point that you made about valuation and how risky capital, may not be available at the cost at which it is available now. Do you think the focus also has shifted of these investors? So the importance of a Fed meet, importance of a ECB meet have come down, and importance of what's happening politically or what are the changes that are happening politically has increased. So even markets have discounted that, it's not going to be available for free.
To an extent, yes, but it's also, I don't think the markets are ignoring the Fed or ECB moves. It's just that in the last few months there has been a little bit of signs of stability in growth both in the US and the EU. So that the kind of comfort on growth muddling along at certain levels at 2% for the US and a little less for the ECB, it seems to be more visible. So people are getting a little more comfortable that though it's not a very high rate of growth, but some rate of growth is now stabilizing, and that we are not going in towards a recessionary scenario. I think that's what's keeping the markets comfortable.
Right. And say, whenever the Fed would turn or they become aggressive, or whenever ECB would turn, it would only be when inflation comes back. It would only be when liquidity is sufficient. So at that point of time, liquidity will not be an issue for assets if it's growing.
Absolutely. As long as, as far as India is concerned, if we continue to show growth, then I don't think 25 basis points or 50 basis points rate hike from the Fed in the next 12 months would impact flows to India. Because when we are talking about earnings growth of 15%, it's a very good, healthy kind of situation to be in.
Right. Just let's talk about, a couple of sectors which have not done well. So, sectors like power, sectors like infrastructure. I know it's very difficult for a company like you to take a call over there, because structurally to predict earnings for a big infrastructure company for next 6-7 years is very difficult. But you believe time has come where some overweight positions should be taken on infrastructure or power?
So in that space, we have always preferred the EPC companies rather than the asset owners. The asset owners tend to become more of yield plays and not so much of growth plays. If you want to play growth, if you want to see growth, it's basically better to play it through the asset light EPC companies, especially companies which have not blown up in the last cycle. So to that extent, our focus continues to be on the service providers to that segment rather than the asset owners.
Right. In terms of infrastructure, are you expecting a pickup to come in the sector as a whole? May not be exactly as bullish as what 2005, 6, 7 was, but you expect some pickup to come in. You can't only have retail growing with the companies not doing very well, which employ in a mass scale.
Frankly, the only action that we've seen consistently in the last couple of years is in roads. That continues to remain robust. But if you talk about power or even capacity building in, say, cement or ports or airports, that seems to be some time away, frankly. Power, there is still problem of demand offtake, and if you don't see demand, I don't think the private sector or even the public sector is going to commit more money into a sector which is already full of problems. So I think that big chunk of infrastructure, which basically is in sectors of petrochem, oil and gas, power, fertilizers, these are the ones which are really capital intensive, ports, etc. We don't see that kind of traction happening. The growth that we can see probably, which can surprise in the next year or two, is in the housing segment, because of a lot of the smaller schemes for the low cost housing and interest subsidy, etc. We might see a lot of action in the construction space on housing, but not so much on infrastructure. I don't see that much of visibility so far.
Right, but so what you're saying is that there is already excess capacity. So capacity utilization will be the trigger for a pickup in this sector, rather than only people coming out and investing.
Yes, so as far as the markets are concerned, earnings growth will come from improved capacity utilization in all these sectors, power, cement, etc. But if you are talking about a capital expenditure cycle picking up, that is still some time away.
Right, Mihir. Thank you so much for taking out time for us. Always good to get a perspective from you. That was Mihir Vora, bullish on consumer durable, bullish on private banks and select NBFCs.